Today's number, guys, is 7 because we've just entered extreme fear with the market only pulling back around 5%. And we now find ourselves at a key point, weekly mean reversion. With options volume starting to spike up into this month's OPEX and, of course, volume itself reaching levels that we usually see during extreme panic, what exactly is going on for us as investors and traders? In today's video, we take a look at the put-call ratio, the free fall in the crypto markets right now that could get a little bit worse before it gets better, and the concerns over liquidity worldwide. Yes, there could be cracks starting to show, and in today's video, we'll go through the good, the bad, and the ugly. Join us as we cover stocks, commodities, and cryptos in the Daily Recap Show. See you soon. Well, welcome back everyone to the Daily Show. My name's Thomas, and in today's video, we've got a lot to talk about. The macro, the options flow, and of course, what has Wall Street been up to? It was a huge rally on Nvidia after good earnings into a massive dump across the board, and it has everybody wondering whether this is the beginning of something big. And we do have some major key levels to look at in today's video, along with big put zones, and I mean huge ones, because this is, of course, the OPEX, the options expiration that matters each and every month. Let's first off talk about these NFP numbers though, because it looks like the US jobs report was okay. And of course, this was actually a fairly old one, being the September report. October will be more interesting. And that's been delayed, by the way. And of course, we know that the idea that a rate cut was going to come is now starting to get taken off. Now, on top of that, we've got concerns over AI. Michael Burry, of course, calling this whole thing basically creative accounting. And we do have concerns coming in here for liquidity. So what really was going on? Well, as we know, NFP or jobs numbers are now the biggest event of the month. The Fed went from a dual mandate where they look after inflation and jobs numbers, and they just said, stuff the inflation, let's look just at the jobs. And of course, what this means is that sometimes it creates the most amount of liquidity. So liquidity can also create opportunity for Wall Street. And something we floated last week was that a lot of fund managers are big time down this year when it comes to retail traders and S&P returns. And what that means is they need cheaper prices so that they can potentially rally the market into the end of the year, on the proviso that they then get their bonus pays. Now, this is a cool chart here from Heinrich over on X, and it shows here that on the same day return, if we're actually down on the NFP, it can be very, very good over the next 3 days, 5 days, and 10 days. And considering the correlation that we're starting to see here in markets, that may make some sense. So let's first talk about some of the extreme fear that we're seeing. And this indicator is most likely broken, by the way. 1 year ago, we were neutral at 49. 1 month ago, we were already in fear at all-time highs. And of course, 1 week ago, we were at 11. Now, when this comes down to it, this particular indicator obviously is based on a whole bunch of things underneath the hood, but we are now sitting on a 7, so an extreme fear rating. And it's very rare to be in extreme fear when you've barely seen a market sell-off. And I know a lot of you guys will say, well, Tom, this is a horrible sell-off, everything's falling. And some stocks, particularly quantum stocks, are down upwards of 50% already off those extraordinary high highs. But you've got to remember, this is the actual way the Qs have traded so far. And this is in the variety of what we call a normalized pullback. Anywhere between 5 and 10% is a very standard correction. And it's actually pretty healthy to occur in upward trends. The interesting thing about this is the volume, guys. Take a look here at Subutrade. He's gone through and looked at the Qs and the SPY, and the last 24 hours actually are symbolic of a flash systematic sell that creates a huge amount of liquidity. Have a look here at the volumes that went through the Qs, which is systematic to what happened in October or in April, and then of course in July of last year. And these are super interesting levels. Have a look here at SPY as well. A massive zone, big volume, big lows, big correlation. You'll see why this is all stacking up when we look at the put levels very, very soon. Remember we talked about weekly 20 moving average? Well, boom, we're there, and we're also at that major support when it comes to the puts. We lose this though, things are starting to get quite concerning. Now, when the CNN fear and greed falls below, Subutrade actually went through and had a look at this one, and he found that actually it was a very mixed result. Now, I'm saying it's a bit broken because I know what the inputs are for this, And I do think that the old results here from 2011, 14, when this used to be okay and did work in that environment, they probably were more accurate. But do remember that it's more of a coin flip. So it's not really worthwhile looking at that particular indicator, at least in my opinion. And I have posted that over on X. Some of you guys will disagree or agree. There are better reads that we use here on the channel. So what about the fact that the S&P gapped up and the NASDAQ gapped up into the open, then got crushed, and then, of course, had this massive turnaround move? Well, this is a big deal. And of course, it can still bring sometimes a little bit more weakness, but generally it's actually strength equals strength. So even though it's strength into weakness, it's kind of like a flash crash that often then is bought up. And you can see here 2 days later after similar reads, we are at 86% likelihood of being up. Now, there are not that many, of course, reads there, but this does start to stack in with a few other things, including the NASDAQ and the McClellan oscillator here, which also went into that kind of oversold read, which does tend to bring with it, again, pretty good statistics when you're looking at it for the next couple of weeks. Now, if you've been watching the show for a while, we knew that 7 months up generally meant that we were going to chop and decline because the first 3 weeks after 7 months up for the NASDAQ were usually bearish. The 4th week was mixed. The 5th week was generally bullish. And this actually goes very well with some of the structures we've seen recently when it comes to losing key zones. So let's talk about the reasons why we could actually be here at around the key level of support. First up, the VIX has actually spiked higher. Now that's good because over the last 24 hours, we were only sitting at around 24. Now we've moved into the 28 kind of read and we've come back off that, but we hit 28. Now remember, when we're sitting in this weird zone between kind of 22 and 26, that particular area there doesn't tend to give us the best returns. In fact, it's better to have low VIX or extremely high VIX. But now we've started to see extremely high VIX, and it of course spiked up, bringing in effectively the bears and huge options premium. And this is all happening into OPEX, which is that big options expiration of the month. Now, there are some canaries, so let's bring up some of the worrying signs for probably more 2026 than right now. But the first one is the American consumer. And I wrote about this over on X, and I'll probably write about it on LinkedIn. Follow in the pinned comment down below, by the way, for the LinkedIn post, because it's going to be a big one. And I'll also put it out for the newsletter as well this week. Because the thing here is that we've got staples and consumer discretionary both down on year to date. And this is actually really rare. The last time we saw this was like 1990. And the thing about it was we were actually in a recession during that time. Remember, 1/3 of the US economy is made up of the American consumer. It's why we often track XLY versus XLP here on the channel to get a bit of an idea of whether things are really freaking out. But this is a little bit different. Both are performing really poorly, along with, of course, home builders. And it is a bit of a canary sign here in the markets that something is weak underneath the hood and people are really feeling it. And we already know this because 10% of the US citizens, basically right now, of you guys, the richest of the rich, they're basically buying everything. No one else is. It's pretty much 10% are buying everything and everybody else is just struggling to hold on. And what we know about that economy is it can go for a little while, but remember, to have a robust economy that isn't just the top 10 stocks and this AI fever dream. And remember, they call it hallucinations when it gets it wrong, guys, which it does a lot. I still think there's a bit of AI slop going on out there. That when that's all occurring, then we basically have a market that is rallying on good earnings until it isn't. And of course, what we saw with Nvidia was, I would argue, good earnings. However, a lot of people, of course, are looking at it as creative accounting and the beginning of the end. So let's have a look here at Grant Hawkridge's cool chart. Basically, he's gone through and he's had a look at whether some of his trend structures are intact. Now, some of these I also use, so I thought it was cool just to have it here on the chart. And of course, we have risk on, risk off indicator. His one is broken, so that means it's broken down. Basically, you've seen leadership, of course, weaken. We specifically lost XLK over the last 24 hours, and you'll see what I mean on the charts later on. But in general, we're still intact on the longer term trends. And I think that's very important to note because, yes, we're seeing a bit of the changing of the guard. Yes, we talked about the market turning more defensive than aggressive over the last 2 weeks in particular. Don's dividends here, by the way, with a really cool chart that we've shared a few times. And what that's shown us is that there's been a bit of a changing of the guard. And that's actually systematic of usually Wall Street creating an opportunity. It could be further weakness that tends into debt, bubble and everything goes bad. But generally speaking, this is the type of rotation you see as Wall Street de-levers a lot of retail traders to then buy the dip. Now, there are some other canaries that we need to mention. These stories are real. The tech sector has a wider spread when it comes to bonds and premium than the overall S&P. The first time we've seen this since 2012. This is an early warning sign of liquidity stress and stress in the markets. So we need to be aware of that. Another one that I want to mention here is private equity, and I think we've got a chart for it soon. Private equity and the overall market are disconnecting, which shows you that when it comes to getting funding right now, it's actually very difficult. We recently saw OpenAI come out and say, hey guys, can we have some more money? Because they're burning so much of it. And the market's like, I'm not sure about that. We started to question these things. This is a problem. So do remember, this takes a time to play out. It's usually a simmering effect, but I would certainly be paying attention to it. And make sure to subscribe to this channel because we'll be covering this topic hugely. There are always times to be panicked. And right now, it does look like this is more of a strength, potentially will bring in strength. Now, you can see here from Subu Trade, also total put volume starting to kind of spike up there. Basically, this just means everyone's jumping on the bear wagon right at the weekly 20 moving average, which is pretty much the point you wouldn't want to do that on. But this is very normal. And of course, what would happen potentially with bottoming style formations here in the markets. And it's now come back to where we'd usually expect it. So let's have a look what happens according to the market stats here when we lose the 50-day moving average after having so much strength in it. It's one of those other good reads where it usually means a month later, we're up 100%. And remember, we've shown plenty of structure here that we thought we might find weakness first 3 to 4 weeks, 3 weeks of this month particularly. Then we would find strength, and that 95% of the time in other structures, we would be bullish. Well, this one says that when we get this read, 100% of the time, the market ends up being bullish. And that's a pretty good stat. Now, of course, there's not that much data. Put risk management disclaimers all over it. Obviously, it's just one read. But it is interesting because what can happen is the market can drop a little bit more here, as you can see from Blue Curtic, upwards of -5%. I think we're actually about between 2 and 3% since this read. You can check it out on the charts if you want to. And then we tend to bounce in all cases. Now, that's really good because it actually works in very well with what we've talked about, which is a rally into the end of the year, which is, of course, mostly for Wall Street to make bonuses. Then next year we get earnings, and guess what? That could be where the concern is, first quarter, second quarter. Then we have the Fed and the chairman and all those types of swaps. It also happened on the NASDAQ as well. Of course, the NASDAQ being more volatile lost more during these times, but ultimately they all ended pretty decently over 60. There was this one, though, that took longer to recover. And that, of course, was from 1986, that classic flash crash scenario as well in 87. Now let's have a look at private equity. So, of course, as I mentioned before, it's harder to get money out there right now. You can see it here from this great chart from top down from Callum Thomas. And this is a disconnect in the market. And what that tells us is that we are now being led by AI data centers. And I don't know about you guys, but to me, it all smells bad. And it's probably going to end up poorly. Now, it's not that AI is not the future. Don't get me wrong. We got to invest in it, and it's going to bring so much innovation. But we've got robots that promise things that aren't really going to come through. We've got hype and speculation, and we obviously have data centers going in everywhere just to get more compute. And the word of the moment is you say DC, and you end up getting a higher market cap. So remember, when this is happening, it's kind of like a fever dream. And that will continue for a while. It's what we call the hardware phase of new technology. It happened with the railroad. It happened with the internet. It happened with mobile phones. It happened with the electricity. It happens with every single technology. And I actually write about this in my course, particularly the advanced trading masterclass. Quick plug to the Black Friday sale down below as well for that. And in that particular course, I go through why I already expected this, why I've been talking about this for years. And of course, you have to ride this thing until, generally speaking, you get kind of the rails come off it. So it's all about debt ultimately, and that's one of the big storylines here. HODL. Now, we did see a little bit of interesting stuff on Bitcoin. So let's talk about this first, because of course I did mention around this 90K mark, we started to see some extremely large trades come in. Now, this is on the VanEck Bitcoin Trust, and they were both sweeps. And a lot of the time, these will spike buys. Now, you can see here, number one went up a little bit. Sound familiar? Went up a little bit here too. Then it went down to make a new lower low. And then, of course, it rallied up. Same thing happened with number three, which was a sweep. And number four just went up straight away. So this is actually a good sign that someone is starting to buy Bitcoin. And I know it may not look like that because it's fallen through trend lines, it's fallen through key levels, and all sorts of things have gone bad. But here's a good bit of information. The ProShares Ultra Short Bitcoin ETF, which also had some shorts on it from a little while, someone started to close some of that position. You can see here, little sweep came in over the last 24 hours right at the close. So that doesn't necessarily signify a complete turnaround and all of a sudden Bitcoin's going to go up, because remember, this is a short, but it does show that someone said, you know what, that's not bad. I'm going to start scaling out my position. And I think this chart here from Jim Bianco over on X really exemplifies where we're at. The average purchase point of all Bitcoin ETF inflows is now in the red. And this is a really interesting chart. I really enjoyed looking at this, and I did retweet it over on X, because what it shows you is often when we get down to these levels, as you can see here, guys, we're at that turning point. And I think this is actually human psychology at play as well, because the average person is now red in Bitcoin in terms of investing in ETFs. They're going to be freaking out, and they're going to say, I can't take the losses around here, or I don't want to go, I was up so much, now I'm down. And they tend to break even their trades or even close them at small losses. And this is actually a very common phenomenon when it comes to trading and investing, and obviously something we don't want to be doing. Now, Michael Green here over on X, he actually has another version of it, and it shows that we're not quite at that break-even price yet. So I'm not sure which one it is, but pretty much that other chart looked pretty good to me from Jim. And it does kind of hold true to what we've been talking about, liquidation levels and stop losses. And we've got a new liquidation level now that we dropped that low over the next 24 hours. So did we see whales come in around 89 to 92K? Yes, we did. Whales started to activate. I'll get some more updated charts on that. And now that we've dropped this 90K, 89K zone, basically the next level is around 83 to 84K. So we're at the moment of this recording sitting about 86-ish, probably get down here. We'll make a decision whether we're going to liquidate there. And of course, it is also open to the potential of in the 70s. Now, a lot of people won't want to hear that, but as I often say, patience, react, don't predict. If you pulled the trigger here or here for whatever reason, just remember that the current trend has still remained in the downward side. And we'll explain that later, because we haven't seen a higher high. All we're currently seeing is, of course, outflows and still big sells. We're getting to the point now, though, where the evidence is starting to stack up for a bid rally, for a squeeze, and we're looking for that structure to come into markets. When it comes to ETF flows, I posted this over on our X as well. You can see it's been red, 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 and it looks like almost a capitulation came through here when it comes to the 18th of November for IBIT, and it went a little bit bullish actually on the 19th. Now, of course, it's delayed data, but we will get updates for it. And it does show that maybe a little bit of buy the dipping is starting to come in. So even though I know it looks like it's getting destroyed at this stage, it actually does show some signs of potential here when we're looking at the markets. So let's now jump on over to the S&P. It is effectively almost hit the weekly 20 moving average. Now, this is not much of a sell-off. Let's actually have a look here and put it in perspective. It's 5.65%. Max fear coming around. Big volume on the SPY. So, of course, consistent more with a 20% or 10% sell-off and a weekly 20 moving average. Now, if you actually go through and you look at the first taps of weekly 20s, they do tend to be pretty good. They do tend to be a fairly decent average kind of level. So you can see here, bounce through. This was one we used. I still remember this on the charts, actually, back when we had the channel early. And we used the 20 several times to get into the markets on the way up. So I usually like the 20. It tends to be a pretty good first tap. So we are at that first level. So let's now have a look at the options for the day. The put support is here. So 6,500. We talked about it last 24 hours. The weekly 20 moving average is here. And the reason we sold, other than that it was, of course, concerns about this and that, whatever other storyline they want to sell you. The main thing here is that we hit the supply. So we couldn't make a higher high, and that would have been a big deal because, of course, if we'd gone to a higher high, geez, that would have been good. Now, day traders in here, you should have been potentially break-evening or scaling out a small portion here, but you would have, of course, dropped the other position. But this is a super important level now. So you can mark up that one. We'll do it now together. We're going to mark up, and we should actually set an alert above this as well, just in case you forget about the market for whatever reason. You want to know when that level's being broken up. That's going to be super bullish for this market now because that's an important level of squeeze and stop losses and all sorts of things going on. So is this good? Yes, it's actually not too bad. So why it is not too bad is have a look at the options expiration size volume. So take a look at that. That is OPEX right there. Look at that. Big, 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 big. So huge amounts, 6,500. It's going to be super hard for it to get under there. So you'd have to expect a bounce with the data. Anything's possible, but you'd have to expect generally markets would bounce this level because 6,500 just so happens to also be massive next week. And it also just so happens to be big as well, even into next week's end of week. So basically, this is really consistent with that data that we've been talking about. Tesla, these things, as you know, I'm not bullish on Tesla at the moment. So it could be coming down to 380, guys, but it is underneath the 400. So it'll probably want to hold that. Nvidia, super thin, weird kind of options. There's lots of options here, but nothing clear. It's kind of messy. And IBIT, interestingly, is underneath now the major strike. So generally speaking, I would have expected 49.50 on IBIT to hold. So what do we find ourselves at? 48.96 at the time of the end. So it'd be interesting to see whether we get a sell, maybe in a recovery on Bitcoin. We're looking for lots of wicks. We got a single wick, then we almost got a second wick in the last 24 hours. And of course, it ended up going bad. But we are looking for wicks. Big wicks often show us activity. So we'll be looking for that. And gold is stuck in the middle of nowhere land. We'll explain that in a moment. All right, let's have a look at the lead indicators. First up is the market freaking out. Not really, okay? And the reason I say it's not really freaking out is I know a lot of people are screaming at me about Japanese yields. We will talk about it on our weekend video, so stay tuned for that. There's so much to go through. I mean, this market is very, very complex right now, but you can see here that we have this resistance. We haven't blown out in spreads yet on the bonds market. We hit a 28 VIX. That's actually very good. I know you might think that's bad, but that's actually good. You don't want to be sitting at 24 or 25. So it's good that we spiked up. That's good. And of course, we did lose tech. So what that means is that technology underperformed the SPY, which is symbolic of course, rotation out, which is nothing new if you've been talking here on the channel and we've been discussing it together. We suspected tech would find more weakness, particularly semiconductors, because it completed one of the technical trends, which was that big flag pattern. But yeah, it has dropped a little bit here, which could signify, again, maybe a little bit of lackluster returns for semis moving forward for a little bit here, and other sectors looking better, which they have so far. The dollar is quite strong, so US dollar, remember, if it's in the press, and today, my goodness, fear is everywhere. I'm seeing it everywhere, guys. If it's in the press, it's often in the price. So if we're getting correlation, we find bid and everyone's freaking out still, that's usually, again, a pretty good sign. So at the moment, the dollar's been doing that. The dollar's been going up while everyone's bearish on it. Good structure there. Does continue to look bullish. We did mention that we thought gold had a day trade on it yesterday, and guess what? It did nothing. It bid a little bit, and then it sold, and then it bid, and then it sold, and then it bid, and then it sold. It was boring. It was terrible, really, but it didn't lose, so that's good. Now, you do technically want gold to buy off here if you're doing the day trade. Obviously, stop loss below there, but a little concerning it didn't find bid. Yeah, it's a bit indifference towards that, and silver did drop more. So you can see here clearly the risk is on silver, because silver is more of the economy and more of a used metal. Gold is more of a stable. So very interesting stuff here for silver and gold. We'll report back after the Friday close. US oil, as we've said, there's no bullishness on the oil itself. We have liked, of course, certain sectors in the market for the last 2 months. One of them did drop a little bit there over the last 24 hours. I'm still bullish oil services, but you can see here it certainly did drop like the other sectors did, but maybe not as much. But the real story was probably just, it shows you why technicals can be really good. 425, too much for Tesla. Tesla's got that double top on it. I mean, to me, it kind of looks like it's going 350. It'd be really interesting to see if this stock can actually get it going in 2026. I mean, obviously, Elon's very good at spinning some great storylines, and so far, I don't know. I was watching some video of Optimus. We'll have to do that together and maybe one of the live streams. I was like, "What is going on here? These robots." It was like you ask it a question. It was it had like a brain malfunction while it was trying to figure out what it was going to do next. I don't know if I'd want that in my house. Would you guys have an Optimus in your house? Let me know in the comments down below. It's obviously new tech, and it'll be an exciting time. Let's take a look at NVIDIA. 180 for the most traded zone. Very important level for NVIDIA to hold. Obviously, it's the linchpin of the markets. This is the most important stock. And I know a lot of people are negative on the earnings, and there's all sorts of things going on, which we'll dissect soon. We've also got an interesting story piece on MSTR as well. I'm seeing some interesting thoughts on the convertibles there. But basically, this is holding. So again, correlation across the board. Another story that we have is, of course, the DAX. The DAX is often a really good read early, and it is right on the level. Weekly close, super important for that one. Semiconductors, right on the level. Again, support, correlation coming up here across the board. And the Qs, as you can see here, and then we'll put the weekly 20 on. Little tap there, little love tap to the 20. So is this normal? Yes, it is actually. It's very common. Now you might say, but the reasons we're going down. The reason to me of an AI debt concern or an AI concern so far is not enough to really think that it is a complete crash. Now you might say, why? Well, because historically strength usually does get a dip buyer. And I just don't think enough Wall Street guys are making enough money at the moment, so they're probably going to want to go back in. But of course, we have to see a bid. We still have not seen that. We've actually gone down to these levels, which tend to give bids, and we'll see whether that happens. Now, Ethereum, and this is why crypto is a bit weird, there's nothing there. We dropped the mini bull level, so now we possibly go down to the most traded zone. There's nothing going on here. You might say, oh, look, the resistance, support, yeah, okay. A fib of some kind, an anchored VWAP of some kind, potentially. But the big problem is that we just dropped that trend line. So obviously the weekly close will be important. Next kind of 24 to 48 hours, the weekend is going to be important here. The new mass liquidation zone is in this area here, around 84K. And I just don't see why it wouldn't keep going down to that point at this stage. So, of course, we're looking for bids. If you have triggered off levels in here and stuff, obviously buy the dip style investing means you're buying without confirmation, and do always look at the small structure. So what we've got right now is low, lower high, low, lower high, low, lower high, low, lower high, low. So is that an upward trend? Not yet. So just remember, do what Wall Street do. If you're going to get into buying the dip, and that's the kind of mental time frame you want to be in there, generally scale is best. And I always say that in our private community as well. Which of course we are launching our Black Friday sale for. So link in the description down below. I also want to just give a shout out everyone that does support us here on YouTube. I do appreciate it. But if you do, thank you very much, by the way. But if you did want access to the private community, make sure to join us at fxevolution.com. The supporter here is more of just a say thank you, and I do really, really appreciate it. So make sure to check us out there if you're interested. But at the moment, guys, this market is, of course, very volatile. There are liquidity concerns out there. There are growth concerns out there, although the earnings have been good. And the question really you always ask yourself is, why are we selling off? Is that really the big one? And it's a question I always ask myself. This time around, I do think ultimately debt is going to be causing a massive issue, but I do also think that Wall Street usually will buy the dips like this. The reason why? They like money and they like liquidating us. And it looks like they've done a pretty good job of liquidation based on what I'm seeing out there. Have a great day. I'll see you on the weekend. And of course, stay safe out there, guys. Bye for now.